Hey everyone. When I was thinking about this video for today, I understand that for most people, um, financial ratios are probably about as dry as the Sahara Desert. But hopefully, through this video, I promise I'll keep it short. I can at least tell you why they're important. So, why should you care about small business financial ratios? Well, first, they can give us an easy way to gauge the health of our business and about two important concepts that are liquidity and solvency. Both deal with cash and the ability to pay your bills. So to cover these topics today, we're going to talk about three different examples. The first of which is Hattie's Kitchen. And Hattie's Kitchen is a really great example of how inventory can really create havoc when you're dealing with a small business and when you're dealing with cash. So Hattie has a really hot cafe in Brooklyn. She was doing an amazing business before COVID, and obviously she was shut down. Then when things started to reopen, she was super excited, and she started to get everything ready, and she bought her inventory and expecting demand to spring back very quickly. And unfortunately, that didn't happen. Okay, so what's liquidity? All right, liquidity is about having cash when you need it, more so when you need it most. And it's the ability to take an asset and convert it into cash without losing any value. Now, sometimes you do lose some value, and that means it's not as liquid as cash is, where you lose no value. So let's talk a little bit about what that means and why that was such a big issue for Hattie. So for Hattie, the issue was her inventory. Obviously, inventory is an asset, but due to COVID, that asset wasn't as liquid because the demand wasn't there. So that brings us to the first ratio that we'll talk about that we think is critically important, and that is the quick ratio. All right, so to calculate the quick ratio, it's pretty straightforward. It's current assets minus inventory over current liabilities. And current assets are things like cash, accounts receivable, and so forth. Inventory is pretty self-explanatory. And current liabilities are any bills or loan payments that you have due during a certain period. I like to call the quick ratios the fire alarm for small business. Obviously, if that ratio is less than 1, you're in big trouble. You want that ratio to stay as much above 1 as possible. If you start to see yourself drifting towards 1, which a lot of people are because cash is tight right now, that's a sign that you need to take action. In Hattie's case, she didn't realize it until obviously inventory was starting to spoil, and her quick ratio was under 1. And luckily, she was able to get a cash infusion from friends and family that were able to keep her afloat. She's since changed her model, so now she's obviously monitoring that quick ratio very, very closely. And why this ratio is so important right now is that inventory doesn't move as fast or isn't as liquid as it is during normal periods. Demand has been slow and likely to remain so for the foreseeable future. Okay, now wine and cheese may get better with age, but accounts receivables do not. So in our next case, we're going to talk about Paul. So Paul runs a small service business who, was able to maintain operations during COVID, which was phenomenal. So that was awesome. The challenge for Paul was the fact that his customers, instead of paying him in 30 days, were starting to take a little bit longer to pay him. At first, he didn't think that was a problem until one month he found he was running short when he came up to pay payroll. And that was obviously a big problem. So that leads us to our second ratio that we'll talk about, which is days of sales outstanding. So days of sales outstanding is actually pretty simple to calculate too. It's your accounts receivable divided by your monthly sales times the number of days that are in that given month. Typically, the average is just to make it simple and make it 30. So when you're looking at the DSO, obviously the larger that number is, the more challenging things are. It's the more number of days of your sales that are actually tied up in accounts receivable versus cash in the bank. Paul's clients were pushing around 40 days, and that was a problem because he was paying people monthly. So the last business we'd love to talk to you about today is Palomino Painters. So try to say that fast 3 times. Jack runs Palomino, and Jack has been in the painting business for quite some time. He's been in the painting business for at least about 15 years. So he has a lot of experience, and he does a lot of commercial business, which was actually quite good within the COVID framework because he has contracts, and so those contracts protect him from cancellation. But he didn't really want to cancel these clients because obviously these clients took a time to build, and he wanted to be able to service them once they came back up online. The challenge Jack was facing was he had taken out a loan a few years back to get some specialized painting equipment. So he obviously had issues with being able to pay that debt. So he wanted to allow them to delay, but he was curious how long he could before he ran into trouble. That brings us to the second concept called solvency. Solvency is a long-term vision of whether or not you're able to pay your bills. So solvency looks at things over the longer horizon, usually around 6 to 12 months. Now, solvency and liquidity can be linked, but they're not always. So for example, Paul is a great case where he was solvent. Clearly, he had no debt, so he could easily be solvent, but he was running into a liquidity problem. Now, Jack was the opposite. So when looking at Jack, we needed to look at his ability to pay his debt burden over a set amount of time. Which brings us to our third ratio, which is the debt to cash or debt to income ratio. And that is as follows, where you take your net income before taxes, so your net income after you paid everything, and you divide that by the sum of your debt payments over that period. So if it's your net income for 6 months, it's your debt payments for 6 months, and so on. You want to look at how large that ratio is above 1, because that tells you that you have a certain amount of cushion to run your business efficiently and cover your debt. So in Jack's case, he went to his accountant to see, okay, so how long, given our current cash flows, can I go with a delay on these accounts before we run into trouble? So what Jack's accountant did was ran the debt to cash ratio to see how many months of coverage they had before they started to run below a 1.2 or 1.15 level for the ratio. And after he did the math, he found that he could delay for about 4 months, which worked out perfectly for Jack. Had he not done this, he would not have known, and if he would have waited for 6 months, he would have been in big trouble. So in summary, Hattie is a great example of how a mismatch in inventory and demand can create a problem and create a crisis. And that's why the quick ratio is really important to monitor. Jack illustrated the second point, which is why it's important to look at the days of sales outstanding. If your customers are taking longer to pay than you need to pay your bills, that creates a cash flow problem. And the days of sales outstanding can help you look at that, and we'll flag that. Finally, Jack was a great example of the debt to cash ratio. He provided you an opportunity to see how long you can remain solvent when unforeseen events happen. So I promised you, yes, I know, that financial ratios are not sexy, but I hope you understand now why they're important, especially given the uncertainty that we're going to be facing as we find our way to the vaccine for COVID. So to recap, the 3 key ratios that are critical in this COVID world are the quick ratio, which when it comes to liquidity, that's your smoke detector. So make sure you catch the smoke before you have a 5-alarm fire. The days of sales outstanding, this is the number of days that in cash that you have tied up in your accounts receivable, so how much your customers are holding back cash from you. And then finally, the DCR, debt to cash ratio, sorry. If you're not above that typical benchmark of 1.15 or 1.2, you probably should be looking at ways to either raise revenue or more likely cut expenses.